A Fed pivot won't save the economy. Not this time. Brace yourself. As the Fed has tried to save us all from inflation by going on the most aggressive rate hiking we've seen in history, they've caused even worse problems than before. The U.S. government has become insolvent. The banks collapsing is just getting started. The commercial real estate sector is about to blow up, and stocks are on the verge of crashing. Many are hoping for the Fed pivot to come and save the day, but get ready because the Fed pivot will not save the economy. So in this video, I'm going to break down what the Fed is doing as the arsonist and the firefighter, the damage they've caused along the way, the damage done to the banks, what to expect from here, what the PMI and ISM leading indicators are telling us, the hidden danger in the latest job report, and the most important indicator of all that's poised for a breakout that could send the entire markets into a tailspin. It's a lot to cover. It's important for you to understand and watch, so let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss, and I make these videos to change the way you think about money because almost everything you've learned is wrong, almost everything you've seen is wrong, and it's very difficult to understand what's going on because they've made it that way. The financial system is very complex, but it doesn't have to be. And if you want to protect your wealth, if you want to navigate these markets correctly to keep what you have and grow what you have, then you have to understand it from its most basics. Let me break it down for you, all right? Now, first you have to understand the Federal Reserve. We have to watch the Federal Reserve. And you have to understand that they are not here to try to save the markets. They are not here to save you from inflation. As a matter of fact, the Fed is the arsonist. I've talked about this before. The Fed is the arsonist and the firefighter. What do I mean by that? Well, I mean, just like it sounds, they're the ones that cause the fires, and then they run to everybody's attention to try to save us from that. All right, now, what do you think would happen if they just rapidly increase the money supply and everyone has a whole bunch of new money? Well, the economy grows. People start buying things. People buy bigger houses and cars and all the jobs that are created. And then what do you think happens when you reverse that and you suck all the money out? Well, you're starting to understand exactly what happens. Now, to show you how that works, it all starts right here. This is the Fed funds rate. This is the price of money. Now, most people understand that setting the price of things, like price fixing, never works. If I say you can't sell bread for more than $1, but it costs more than $1 to make bread, then people don't make it. Price fixing never works. But what the Fed does is they set the price of money. And by setting the price of money, they set the price of everything else. And so what happened is after 2008, they moved down to what we call ZIRP, zero interest rate policy, zero. And they kept it for 7 years, kept this at almost a 0%. Free money, if you can get it. Then they tried to get back to some sort of normalizing, and they started raising rates, as you can see. But unfortunately, the economy doesn't like that. It's a Ponzi. You can't taper a Ponzi, and so the market crashed, and they had to move right back into zero interest rates and kept it there as well. So we've had all this time in zero interest rates, and the economy has expanded like crazy, one of the longest bull markets we've seen in history, and everything is booming, including inflation. You can't afford the price of gas or steak or milk or to travel or a house or anything like that. So the Fed has to do something, right? They have to put out the fire that they started, and so they do. So they go on the most aggressive rate hiking cycle that we've seen in history. So they're the arsonists, they set the fire, and now here they are to save it, putting us on the fastest tightening cycle in history. Now, they've started to taper that, so they took all that money that they pumped into the system, not only by expanding their own balance sheet, but of course by keeping rates at a low rate. Remember, money is created through debt. So when the price of money is cheap, people take on a lot of debt. That money is created. And so you can see here's 2008, the balance sheet expanded through 2020, and then here in 2020 through the pandemic it expanded. But this part right here is where they went on to this tightening cycle. Okay, we're gonna get back, we're gonna raise rates, we're gonna shrink the amount of money in the system, and so they started raising rates. But unfortunately, you can see right here that it didn't last long, and they've already had to start increasing the money supply. Now, I've already talked about this. We've broken this down into many, many videos already. So I don't want to dive deep into this. What I want to get to is the data points that you need to be watching. All right. Now, what we know now is, like I said, everybody's waiting for this Fed pivot, and it looks like it's finally here. As a matter of fact, what we can see is that there's less than a 50% chance of another hike in May, so it's not the most probable case that we'll see another hike. And then it's actually projecting that we'll see rates going back down. The actual pivot will come this year. All right, that's what the market's showing us, but we need to look at some other data points to really get a picture of what's going on. Now, I put this here, do they know what to do? I've been very critical of Jerome Powell. I've been very critical of the Janet Yellen, the Treasury Secretary, and I say they're idiots or they're incompetent or whatever it is. I would say that anybody in that role would be. And the reason why is because anybody that thinks that they can control an economy with a single lever like interest rates is, I guess, an idiot. So it's not just that they are, it's that the entire premise that they can control that with one lever is idiotic. We're going to come back to that in a minute. But the Fed has 3 mandates. Really, the Fed has 2 mandates, but we're going to give them 3. The 2 mandates are stable prices and full employment. You might probably heard that before. So when inflation, their target is 2%. Their prices to go up by 2% a year, or for you to lose 2% of purchasing power per year. That's what they call stable prices. As long as prices are going up, or I should say the dollar's going down, but it's going down predictably, it's okay. Then full employment. Do we have enough people working? The third one, though, is really an unspoken one, and this is to have a stable financial system, meaning that the banking system works, there's liquidity in the financial system, loans are happening, things like that. But the problem is that we are seeing a deterioration of the real economy. So in order to have stable prices, full employment, and a financial system, you have to have a real economy, meaning you have to have real businesses that are providing real goods and services. But if that starts to break down, then everything comes down on top of that, and we're starting to see a labor market unwind that's already happening. We're starting to see the financial system, the plumbing, where the money moves within it, is starting to freeze up. That's why banks are starting to go down. And all 3 mandates that the Fed is required to have are all failing. So if we're going to give them a report card, I think they have an F. They're failing for sure. Okay, now we've been hearing about this proverbial soft landing, so to speak. The Fed wants to get us into a soft landing. They want to bring things back down to earth, but not crash land, not a crash, a soft landing, which I think is a ridiculous metaphor in the first place. That makes you think that they must have some like fighter jet pilot cockpit with a million switches that they can control every little single thing, all your wants, needs, and desires, and all the manufacturers' ability to fulfill your wants, needs, and desires all at the same time. Come on, they don't have that. They're more like a hot air balloon. They have one lever. They can inflate the balloon with hot air, or in this case, inflate the economy with money, or they can deflate the balloon with hot air or deflate the economy with money. That's all they have. And they do it through interest rates. Instead of a lever like a hot air balloon, they do it through interest rates. Lower rates, bring more money in. Raise rates, suck more money out. All right? So they have a limited set of tools. They really have one tool. Now they can start to prop up other companies as they're failing, which they're doing right now with the banks, for example. But to manage the entire economy, they have just one lever. So if they want to slow down inflation, which is what they've been trying to do, okay, let's just raise rates. But the problem is, as they contract credit, it slows down the economy. Because we're in a debt-based monetary system, when credit contracts, when I can't get a loan to buy a new truck for my employees, I can't expand my business. When I can't, when I can't get a loan for a house, and now there's no home builders working, that slows the economy down. In a credit-based economic system, credit expansion is what lubricates the growth. So we always have to be growing. If we're not growing, then we're crashing. There's no such thing as going down. Now, we're already starting to see the credit contraction underway, and it's a vicious cycle. Higher rates equals depositors leaving the bank. So as the Fed started paying more and more money, so the Fed's going to pay you 4% or 5% on your money if you buy a treasury, and the banks pay you 0, what are people doing? Well, they're leaving the banks and putting their money into treasuries. So higher rates equal depositors leave the banks, but then that puts massive stress onto the banks. We've already done a video on that. I'm not going to break that down, but you understand now people are taking the money out of the banks. The banks have enormous stress. They can't do loans. Now all this funding stress that the banks are in means that they can't do loans. They have to stop lending. Well, when they stop lending, that creates even more stress because now there's no expansion in the economy. This more stress equals tighter lending. So now the economy's not growing, the banks are under more stress, they have to stop lending even less than they were before, which means we get to no growth. It's a very vicious cycle that we're in. Just like the expansion winds up, it also winds down very fast. The economy, which are made up of consumers and businesses, remember, real goods and services, the economy then crashes. And of course, we're in the downturn phase of this right now. You can already see this right here. This is the commercial bank's total deposits. Now, this may not look like a big number, but that is a massive decline in the monetary supply in a very short period of time. This was just from the 2020 stimulus, not just, but you can see the size of that move, and we're already seeing almost the same size of a move right there, just people pulling their money out of the banks. That's how fast this is winding down. And to show you, I love to show you the charts so you can understand this. This is the banking sector lending risk premium. This shows the amount of stress that the banks are under, and you can see how high we're up right now. Now, only when we've seen this before, here's the 2020 pandemic. So we are much higher than we've been at any time in the last 10 years or so. Now, to show you how this is kind of like this downward spiral, you can sort of see this. We have an expansion, the money supply expands, but then we have the economy downturn. Then we're going to have to rebuild things, and then hopefully we can have a recovery at some point. Just to recap how this works so you can understand as we continue to move on, I want to make sure you're keeping up because I'm going to show you these indicators that you want to be watching. But to understand, to recap this, the Fed raises its policy interest rates. They raise the price of money. The problem with this is that as they increase the price of money, there's a lag. It takes time. So typically we have a 12 to 18th month lag for the policy to take effect. So what they do this month, whether they raise rates or not, we're not going to know for a year to a year and a half. All right, first, we see it happen in the financial markets, and then we'll see it trickle down to the economy. So you have to make sure you're looking in the right places. Now, to show you kind of what we're looking at, remember this chart, we already looked at this, but we started raising rates 12 months ago. It takes 12 to 18 months to start to feel the effects of that. So they went on the fastest rate hiking plan in history, but we haven't had time to absorb that. So right now, we're on the 13th month. So we're just now starting to see the damages and effects, and just wait for the next 6 months because it's about to get fun, and I'm going to show you a couple charts to back that up here in a second. But basically, we already have this liquidity, this credit crunch, this contraction is already underway. We're already seeing massive bank stress. They're already failing. We're seeing this is leading to less consumer and business credit. People aren't taking as many loans as they were before, and so we start to get the contraction. All right, so let me run through some indicators that you should be watching. These are the ones I'm watching. We're going to start with looking at the economic outlook, the economy, what's going on. Remember, the economy that makes the real goods and services, real consumers. That's the important piece. Now, one of the things that we always want to look at is what's called the PMI, and it surveys business managers. That's Purchase Manager Index. And basically what they do is we take a look at all the purchase managers and a survey is run to see what they think. The Purchasing Managers Index, PMI, is a measure which shows the direction of economic trends. So through this survey, we can get a gauge of where the economy is going. It can provide useful insight to business decision makers, market analysts, and investors. So if you run a business, or you like to analyze a market like I do, or you're an investor, maybe I'm all three, then you want to keep your eye on this. It's a leading indicator because this tells us what's going to happen. You don't want to look at lagging indicators. The stock market tells you what happened. We want to see the leading indicator of overall economic activity. That's why you want to watch the PMI. All right, now the way it works is the PMI is compiled and released monthly by the Institute for Supply Management, ISM. All right. Now, there's 5 major survey areas. They look at new orders. They look at the amount of inventory on hand, inventory levels. They look at the amount of production, the amount of goods and services being produced. They look at the supplier deliveries, and they look at employment. Now, they weight all of these things equally. They add them up, and they get the headline PMI number, and it's a number from 1 to 100. And basically, PMI above 50 represents good, a bullish market, an expanding market. If it's below 50, it's contracting. Now, the further from 50, the worse it is. You might understand that. So what is this telling us right now? Well, what we can see, if we look at this chart right here, is that we can see we're down into the 40s on ISM manufacturing. Remember, this is a leading indicator. This tells us what is about to happen. So every PMI survey from ISM is now 50 and falling steeply. Remember, it's not always the exact number. What we're also looking for is the direction, the speed, and the size of the move. So this kind of shows you how it is right here. If we have the Fed easing, so making money easier to get, then the economy expands. Then the Fed starts to tighten because they ease too much, and then things start to contract. Then the Fed has to ease again, and you get the picture. An elementary kid could tell you what's going to happen next by looking at that chart. It's so simple, even a caveman could do it. Now, this kind of shows you a combination of three factors I like to look at. The ISM manufacturing, we just looked at the PMI. Consumer sentiment, how consumers are feeling about this. We like to look at the University of Michigan report, and the small business optimism. And what you can see is that anytime this starts dropping here, we're in recession. This is the 50 line that we are talking about right here. And so you can see we're getting well down below this 50 line. Now, you might realize it doesn't fall below there very often. As a matter of fact, it fell below there in the 2008 great financial crash. It barely touched the line in the 2000 dot-com boom, right? We saw a little bit back here in the late 80s, and again here in the mid 80s when inflation was sky high. It rarely ever gets to that line, and when it does, it's not a good sign. All right, some other things we want to look at. The labor market is turning over. This report came out last week. It's called the JOLTS job opening, and this basically shows the demand for labor in the market. So if business is booming, then employers are hiring people. They're growing their business. When they're not hiring, then it typically means that business is not very good. And we just saw the most rapid decline in a century in labor demand. In a century, 100 years. It's the largest, fastest rapid decline we've seen, except for March of 2020, which is an anomaly because, of course, the government shut down businesses, so we have to draw that out. Now, jobless claims will typically follow that, right? So these are leading indicators. It tells us what's going to happen. So what happens after that is unemployment rate will go up after that, and so then it will follow. And supply and demand will come back into balance in the form of unemployment. That's how the market equalizes itself out. Now we can see, if you want to understand what the JOLTS report is a little bit better, it's a monthly survey of U.S. job vacancies, hiring and job separations released by the Bureau of Labor Statistics by the government. It gauges labor demand while the number of quits, and it helps to measure labor force turnover, so it shows you how it's doing. It's the numbers for job openings and voluntary separations from employment. Oh, this is a good one. If you remember, in March of 2022, we had the highest number of job quits. So that was when the economy had been doing really good, coming off the back of that. Now we're seeing the opposite, the largest decline that we've seen in 100 years. All right, another indicator that you want to be watching is oil, OPEC. Now, I did a video talking about OPEC attacking the United States by lowering the oil. And I said it could be that, or they could just see that there's a slowdown in the economy happening, and so they're trying to lower production so they don't flood the market. And so that looks like it potentially is what's happening. OPEC cuts, most people think they're inflationary. Supply and demand, right? So if there's the same demand for oil, but they reduce the supply, that'd push the price up. Unless the demand for oil drops, which is what the Fed's been trying to do. And it looks like that's exactly what's happened. The Fed has tried to crush demand by making everybody broke, and they did. They crushed the economy. The economy is now falling, and so then the demand for oil could drop. And so if the demand for oil drops as they're reducing the supply of oil at the same time, then we don't necessarily see the price of oil drop. We haven't seen a big oil price drop at this point on the back of all this slowing demand. So it looks like it's holding right around this $80 price point where it's been for about a year. So another indicator to show you that this economy is slowing down fast. All right, and the final indicator that everybody should be watching is one we've talked about quite extensively here. It's the yield curve. But it's not just the yield curve inversion that's the problem. So what am I talking about? Well, the yield curve is the price for money over the curve from 2 years to 5 years to 10 years to 30 years, etc. And typically the way it works is that when you borrow for a shorter term, it's cheaper, and the longer you want to borrow for, the more expensive it gets, which makes sense. You want to get paid more money for taking more risk over a long term. The problem is when this inverts, when it's more expensive short term and it's cheaper long term, which doesn't make any sense at all. And so what we can see is that's exactly what's been happening. We've talked about this extensively, but that's not the problem. The problem is when it inverts like this, which has already happened, it tells us that a recession is coming. All right, we can see that it is inverted right here. Here's some of the charts. So we have the 2-year, which is one of the best ones to look at, the 2 and the 10. So the 2-year, it's 3.86 is the price of money for 2 years, but it's only 3.35 for 10. It's only 3.5 for 30. So it's much cheaper for 10 and 30 than it is for 2. So it's inverted. That's a problem. It tells us that a recession is coming. But the bigger problem is when it uninverts or reinverts. That is the big problem that we want to watch out for. And so what we can see is when it re-steepens, when it goes from being inverted to going back up, what that means is that we're going in a recession. So if it inverts, we have 12 to 18 months, but when it reinverts, when it steepens, that means we're entering a recession. Now, at this point right now, we're still technically inverted, but that is closing, and it's closing fast. As a matter of fact, you can see right here, it's trying, it's been getting rejected, and once it breaks through right here, we will have re-steepened, and that means we are now entering the recession. It's literally knocking on the door, about to show up any day now. All right, so what do we do with this information? What should you do if you're an investor or a business owner? Well, brace for impact. All right, credit contraction is in the way, right? People are buying less homes. That means if you're a home builder or anywhere in the home building industry, you're seeing a slowdown, right? We're seeing a massive credit contraction underway in banks. Banks are collapsing. Pain is being felt all throughout the real economy. We see crude prices are holding even after all the supply cuts. We see all the survey data, the PMI, the ISM, all that data, the JOLT job reports, all contracting across the board. And we see now the yield curve is about to reinvert. All right, the slowdown is here. It looks like, based off these indicators, within the next couple of months, 3 to 6 months, we'll probably be in a full-blown recession. Now, we don't know, we don't have a crystal ball, but this is what all the signs are telling us. This is the base case until something else changes. But we want to look at this data, keep an eye on all these data points, and that's going to tell you what's going to happen. All right, what do you think? Do you think we're in for a recession, or do you think the Fed can save the day? Let me know. In for a recession or Fed save the day? I'd love to hear what you think. Of course, as always, give me a thumbs up if you like the video. If you don't, you can give me a thumbs down. That's okay. At least tell me why in the comments down below. And that's what I got. To your success, I'm out.